Hey, welcome to NAAIM Confidential episode 34. I'm this week's host, Ryan Redfern, and today we have Brad Hartman from Hartman Financial Planning in Santa Clarita, California, also North Los Angeles, if you know that. Brad, longtime NAIM member, awesome guy, one of the few options traders, which I think is kind of fun. We're going to dive into, but he's also a big planner. A lot of the guests on this show tend to be active managers, but he's both an active manager and very big into planning. And I'm finding more and more financial planners are getting into this active management, getting defensive, protecting money in certain environments. So I think that's going to be a fun thing to dive into. Also, super fun. Used to be a Disney Imagineer. We're going to go into that a little bit. I think that's the coolest thing ever. Sorry, Brad. I
It's
had
all
to say
right.
it.
That's all right. It was a big part of my life for quite a while. So
I understand. Awesome. So let's dive into the name exposure index. It was called the sentiment index. Let me share my screen. All right, we got the should be going. There you go. Currently at 70.65. I know personally I was at 70 for this week.
and I
Brad,
did
you
75. So we're pretty close to the average there. So
we are the average. I love that. Sometimes it's way over and way under. Some guests don't really change it that much week to week. How much does yours change from week to week?
it doesn't change a whole lot, mainly because I do have some core holdings we can talk about later where I'm got some income generating stuff. So that
Yeah,
stays invested most of the time, and then I have other
sure.
stuff that goes in and out of the market. So
Okay. So what would be the range that you would typically report?
I'm probably more like a 55 to 80, something like that, maybe in
Okay.
that range. Yeah.
I would say in contrast, I'm a 190 to negative 80 is my range. So,
Wow. Okay.
so I'm one of the ones that pushed it a little bit further.
You're like triple aggressive active compared to me then. Okay. Got it.
Maybe, but it
Yeah.
takes all types, right? It's there's all
Well, yeah,
kinds of
we all
me.
have our own style. That's what's great about the group because it's always fun to see how other people do stuff, and we all seem to do well, even though we approach it different ways. So that's kind of
Absolutely. And I think it's funny because as when I was the president of NAME, I was always asked like, "Oh, you guys are just a bunch of day traders." I'm like, it's really not true. For a lot, it's mostly swing traders and somewhere in that middle
yeah.
range. We're not
I
sitting
don't
here trading
I
all
don't
day.
think there's a lot of day traders at all. I mean, I do some really short term stuff in my options. We can always talk about
Sure.
it, but for most of the client stuff, there's no day trading in the client stuff. I mean, but there will be, we change things around, of course, but no, I'm not. I don't think there's anybody named as really day trading.
Not really, not too many.
No.
Maybe Ben Fox a little bit, but I don't know. Anyway, yeah. So let's dive into you. What do you? I know you got some slides for us, so we can have a guidelines of what to
Sure.
talk about.
Yeah.
Love to hear about your process, what you do, how you use active management in coordination with financial planning. I just find that so interesting. So I'd love to hear about what you do out there in Santa Clarita.
Sure. So basically, I'll do the quick little 3 minute spiel about my background because it's kind of fun. So I used to be an Imagineer. Kind of a weird story. I was actually in France for a project for Kuwait when Kuwait got invaded. And then I wanted to stay in France. So I got a job building Euro Disney, and that's how I basically became an Imagineer. Helped build that park. We built a really cool space mountain over there that's based on Jules Verne from the Earth to the Moon. It's got a basically a cannon on the outside of it. You put the train in it. It's got a hook that comes up sort of like an aircraft carrier, shoots the train out, goes around, does some loops and horseshoes and all kinds of cool stuff. So that was a lot of fun, and I did a good job on that. So they asked me to move to California for Imagineering. So that's how I ended up in California, the one place I said I would never live, and guess where I still am, of course. So that's where I am. And then I went back at one point to build Buzz Lightyear in France. I'd also done it in Japan, and they were giving me a hard time about taking some time off to have my first kid. So I said, maybe crawling under ride tracks at 2 in the morning is not the best lifestyle with young kids. And actually, it was funny. I'd already been helping people at work pick their 401k choices, their healthcare choices. We had started an investment club with one of my managers who was a big options guy, which is one of the reasons I got into options.
Nice.
Um, and then I actually did the CFP program at UCLA Extension in the evenings outside of work. I came back. Disney was downsizing. They often like ramp up for big projects and they reduce staff. So I took a package and used that money to start my business. That's kind of how I became in the financial planning. So my big
Nice.
joke now is I used to build the roller coasters. Now I ride them in the stock market for my clients. So I had to. That's why I call it the ride system because I used to build rides. So that's kind of my background there. So
That is fantastic. So are you a CFP?
I passed the CFP exam. I think we had this discussion. I don't want to do much detail, but I'm not currently on the registered list, but I've done all the CFP program and the CE and all that stuff. But we'll do that conversation offline if you want something.
No, that's fair. That's fair. Just wanted to ask.
Basically did all the training, all the results, passed the test and all that stuff. So I've got all the background of CFPs.
No, I love it. I mean,
yeah. And I did that because as an engineer, I understood I wanted all the training, and the CFP was great because it gave me the exposure to insurance and all those other things that I didn't know otherwise. So the investment part I was pretty comfortable, but I wanted to learn about the insurance and a lot of the other aspects that you don't get.
Right. And taxation and all the retirement.
Yeah,
No,
exactly.
I did it, but I chickened out and got the CHFC instead of the CFP. So
Okay.
I didn't take the big ugly test at the end.
The ugly test was fine. I mean, that wasn't bad. And the options part was a breeze for me. So that's what a lot of people, falter on. So I was like, whatever. So that was
love it.
yeah.
Sorry, go ahead. Your value proposition.
So the way I do it, I do financial planning, and I've been told you're not supposed to use the word comprehensive. I try to use financial planning that covers all aspects of your life, right? So including Social Security, Medicare, different life changes, college planning, etc. So I try to cover all the different areas. And then based on the financial planning, what I tell clients is we'll figure out first what your money needs to do for you to last in retirement and to give you a lifestyle that you want. And then we'll go figure out how to invest it. So if people have tons of money, we don't need to take a lot of risk. So why take more risk than we would need to? If some people don't have a whole lot of savings, we might have to be a little bit more aggressive with their investments. So that's why I kind of do that part first. Then I do the investment management. We'll go a little more detail about, I kind of like to allocate their money. And then I do ongoing support for life events because, they retire, they'd have to make their choices to pick Social Security, which Medicare choices and so on. So I try to ask, cover that part of it. That's sort of the ongoing support system. I like options. I've been doing them since at least 2008, I guess. Right when the market was crashing was the perfect time to learn how to trade options. It was a very fast learning experience.
Yeah.
But it was great. We had tons of volatility to sell, so it was fun. So I use options for income and risk management, and we go a little bit of detail of that. And then I like volatility strategies. I don't know if you remember, it was probably, what was it, like 2018 or something? I did the NAAIM Shark Tank. We had the Shark Tank back in the day. And I did a volatility strategy. Got second place, not too bad, almost won. Yep. But basically looking at some of the VIX turn, some other indicators and using that to figure out when you want to be short volatility and long volatility. And I still use that today for myself and for my client stuff. So.
Right. And I was there for that. I saw you present that, I think 2018. I believe it was in San Diego.
Yeah, it was. It
might have actually been where I met you first. Yeah.
Yeah. It was a little stressful, but it was great. And I got to meet a lot of people that way because people came up and
absolutely. But interestingly, on that volatility front, volatility blew up a year later. Like
my system had me out of Volmageddon, so that was awesome. So
that's fantastic.
Yes, I got out a few days or a week before, and I know some other big option traders that I've mentored with or traded with in the past, and they got creamed. So it was good to have a structured system that said when it was time to get out, because that saved the bacon.
If you're still using it, it must be a decent system because that was a bad blow up.
Oh, it was. Yeah, I was like, some people lost millions. Huh?
Instantly.
Yeah, and we will get it. But the way Credit Suisse shut down the product was not very nice. I would say. I'll just put it nicely now.
Yeah,
a lot of people got fair. Yeah, so I don't really use any of their volatility products anymore. I'll just be quite honest, because I don't trust them. So there you go. After that, it's meltdown.
Totally fair. Yeah. Bless your overview. I think you have process.
Yeah. Do you want to go to the next slide?
Yeah, sure. Unless you had more on this that we missed.
I think on the other side, I go a little more detail, sort of each of these different levels. So if that probably is fine.
Let's do it.
Oh, I've got it, don't I? I'm thinking, hang on. There we go. Okay. So
you're in charge.
Oh, I forgot. I'm still tired from hiking with the Boy Scouts last weekend. It's fine. Okay. So I just kind of did a quickie thing. I don't want to know all the details, but part of my whole thing, and I know that, we have the financial planning mastermind group now with your wife and Greg and Bill and so on, which is great. And we kind of looked at, everybody has a little different process. I just sort of give you the highlights. So typically somebody calls me and says, hey, we want to see if we can afford to retire. It's a pretty common question, right? And so then I say, all right, here, these are the things I do. And they say, okay. So I'll have them give me a preliminary questionnaire, and we'll look a little bit that tiny bit. And then based on that, just to get a ballpark figure, like I don't know if they have $1 million to retire, they have 5 million, or they have 250,000 and they just can't afford to retire. I have no idea, because obviously in the LA area, you're not going to retire on $250,000.
No.
And so then, I usually do a get acquainted meeting, then I meet with them and I give them a list of things that I need for information to be able to do a reasonable analysis. And also I look for some of their goals. So for instance, I can talk about one of the things I do my time, and I'll just jump back and forth a little bit, but like I'll say, money is an emotional thing as well as a financial thing. So like say, for ask people like, what is money to them? What can it give me? And how wealthy people are. And this is always interesting. I have a whole big questionnaire, but these are just like 3 sample questions. Typically, the women worry more about security and the men see money more as freedom, but it's not always the case. And one of the things I've learned, and I think we've talked about this at some of the NAAIM conventions, is when you ask the questions, ask the quiet spouse or partner first. Because oftentimes you'll have a dominating partner and they'll give an answer and the other one might be not as strong or weaker and say, well, they don't want to like contradict their spouse or partner. So they'll like try to follow along. So the best thing is just like whoever talks first, make them be quiet and then ask the one that's the quieter one. And you usually get the real answers. So what I usually do is I would give these as a written questionnaire in advance or in the meeting. If they give it in advance, I tell them each have to do their own. If it's at the meeting, I literally give them each one and I'll just tell them okay, it's like school. You got 5 minutes to fill this thing out. Don't think about it. And I make them do it separately because then I can look at them and compare them. So, and then we have like, how comfortable they are with different aspects of their financial life. And then I have another one that's not shown here. That's like their goals. Is it a short-term goal or long-term goal? And what's the priority of it? So we can kind of figure out what are the most important things to them.
No,
So.
I love that because from what I've seen in planning, and I don't do the planning, I'm more the trading side of our firm, but my wife Laura is the planner. But I've seen success rates are so much better when the couple or whatever couple they are on the same page and not trying to do different things. That is such a differentiator in planning. I mean, really getting people on the same page is really almost where the magic happens.
Yeah, and you know what? It makes them stickier clients too, because once you've done the planning and they know that you understand, you've come to an agreement sort of what their goals are and what you're trying to provide for them, then they're not just looking at returns, they're looking at, at what am I getting out of this lifelong? Because and I'll be honest, I give them pretty conservative results expectations. I bump up inflation a little bit, I bump down returns and say, let's just plan for worst case. And if it goes better, then you can take a bigger vacation than we planned. But I try to do that. And then the other thing you can do at this level, which some people do, is they'll create even buckets and say, okay, let's say the wife is really worried about security, and I'm just, but it could be the husband, but either one, and just say, okay, we'll have this amount of money that we're going to invest conservatively that's always there to cover those expenses. So you don't worry about like having to sleep in the street. You're worried that we're going to run out of money. Okay. And then you can say, well, maybe the other partner likes a little bit of speculation and aggressiveness. And you say, okay, let's take 10% of the money and go put it in options, or everything's options. I actually use it more conservatively, but it could be in some high flying stuff. Say, okay, you want to put $5,000 in Tesla. Fine. Let's go put $5,000 in Tesla and it'll be going up and down every month or whatever, but we're not going to assume that as part of my core returns. Okay.
Right.
So I think by doing that and addressing both of them, they both feel like they're heard. They both feel comfortable and they're more likely to stay the course because they're getting what they want out of it instead of, I don't know, that it's just, you want to meet both of their needs. And only once in my practice, I had people turn their back on each other. That was kind of funny. They're like, wow. That's like, I'm like, okay, well, they didn't last a long time as clients for some reason. I can't imagine why. So then we do the financial planning, put together a plan. We review the plan together. And then we tweak the plan as needed because sometimes, there might be a new goal that came up in the meantime, or they say, well, this is really more important than that. And so we'll do that, present the final plan, and then we have the follow-up. And then once we've done the plan, then we talk about the investments at that. So my approach is, and not everybody's that way, I say, let's do the investments last and then see where we're at. And I just think that way you build the rapport, you build what you're really doing with it. And then the investments are the secondary conversation.
Well, I think at that point you can then really customize what they do to match what they asked for. Because sometimes clients are like, just make me a bunch of money. It's like, well, what's the risk? There's so many more factors to consider than just make me money.
Yeah. And for instance, and I mean, most of my clients are, let's say, 3 years from retirement or retired, right? So they're kind of in that ready to retire thing. And so in some cases, like, okay, how much cash do we need to keep for living expenses, right? So once we've done the plan, we know how much is coming from Social Security if they've already started that, how much from a pension if they have one, and so on. We can say, we need $50,000 a year out of the investments, let's say, that on top of that. Then we can say, well, I like to keep 2 or 3 years worth of cash available if we can. That way I don't care what the market's doing when they have to take the cash out, right? And then I can be more aggressive with my whole system. So that's, and we discuss that, and then they're comfortable. They say we need this much, and then or they may come and say, oh, well, we need to remodel the house. We need an extra 35 grand this year. We'll say, okay, well then let's free that up when the market's up, or or put that aside in a separate account or whatever to handle those things. Then of course there's risk tolerance, and once again we have couples. The risk tolerance can be identical or it can be exactly opposite, and so that's where you get to that bucket that we talked about. And then based on that, I create a personal portfolio for them. And then also as part of the planning, I know we've discussed it quite a bit in the financial planning group, tax plan, some Roth conversions and so on. Sometimes, depending on their level of wealth, it would make sense to do some Roth conversions earlier to reduce the required minimum distributions later, and some different things like that, or whatever tax bracket they happen to be in. Or in some cases, I've got some people that are retiring at 60 and they're not going to be taking Social Security for 5 to 7 years. So let's go ahead and do Roth conversions over those 5 years at the low tax rate where they don't have that much income and they're just living off their investments. And then once they have RMDs, we've already got the amount they have to take down. So different ways to play that.
To jump back a little bit, I love that you do like a bucket or like a 3 years worth of income, because I've seen, and early in my career, you had clients who like, oh, I need a whole bunch of money, and it's like, wait, you're about to wreck your retirement, but I need it now. Gambling losses in Vegas, I need to cover 10,000. I had a client blow up their retirement account that way.
Oh,
and
really?
they'd always call, they would always call on the absolute worst day, and I had to sell that day, and now I do keep 3 to 5 years of income, and then I control when I do the selling to fill that bucket, not just because on the whim of a client, because that can be really messy.
Yeah. And it all,
Sorry.
each circumstance is different, right? It really depends also on how much like how big their pension is or Social Security is, because then there may be enough cushion there already. But that's great.
Exactly.
We don't. And then there's always the other part of it too, is that you got to talk them off the ledge occasionally. Not very much. I usually have that conversation way ahead of time, and that was discussed at one of our NAAIM conferences. Is like already set the expectations, so when things don't look good, they're already understand, and you're not trying to talk them off the ledge when they're like 2 inches next to the edge, right? So
absolutely.
Yeah, that's most of that stuff. And then as far as the plan, we've had some discussions about what we present in the plan as part of our financial planning mastermind group. And I just did some quickie screenshots. I mean, we've all talked about this, and we vary completely across our group. I mean, Greg's got like a 1-page plan. I've got like a 28-page plan. Some people are in between. I mean, the reality of it is I probably focus on 3 pages. So I just did some screenshots. One is like, when do you think you should start your Social Security? Another one is, how long is your money going to last? And then sometimes you get the client says, well, I don't plan to live that long. And I said, well, or I don't want to live that long. I said, I understand, but I don't want you calling me saying, hey, I'm out of money and I lived longer than I planned. Okay. So let's approach that. And then of course, just sort of a cash flow or a capital analysis saying, at the different ages, R is retired on this particular software. Now, this is how much we need a year to live on. This is pretty moderate because they already had that mortgage and everything paid off. It's just a sample plan. And then here was the mortgage. Oh, we had 6 years of mortgage to finish, I think it was, and then they were done with the mortgage. And so this is how much money we need to take out of the capital. So this is not really LA living style here. This is just a sample plan, because it would be more like a couple times this at least.
Right.
But these are the things. Then we just sit with the plan, and I go over like the 2 or 3 main pages. And then if there's an engineer, they're going to want to go through all the data. But if it's somebody, most people are like, okay, good enough. We got it. Yeah. We see the green. We still got green. Life is good. That's basically what they want to know. Right. So,
right.
But, and a lot of it is even people, you show them that they're good and they still are uncomfortable because they're so used to living with a paycheck. And the whole idea of spending down taking out what they've been saving all this time is still kind of scary to them. You have to
absolutely
spend some time with them and say, yeah, you'll be fine.
Yep.
So perfect. Investments used, because this is the name. This is the core of the NAAIM group, right?
Well, I figured like certainly you got to show us now. How do you do that? How do you make that magic happen?
Right. So I'm a big guy. I like individual stocks. Now I know that some people don't. My whole thing on this is a couple of things. One is some experiences I've had in the past. So SDY, which is a dividend paying fund. I don't know if you remember the micro crash. When was that? That was 7 years ago, 8 years ago, maybe now, maybe more.
Flash crash, yeah.
So I remember like SDY, like all of a sudden Coke went from $50 a share down to like $30 a share for about 5 minutes, right? And then it bounced back up to 40, and then it went back up to where it belonged by the next day. So this whole idea of having these funds and then having some kind of a stop loss, I don't like at all, because you can get this weird pricing and you get stop lossed out. So I like to go and pick the individual stocks, because when the market goes down, people have to free up liquidity often, right? And the easy way to do that is to sell funds or to sell bonds or something big. Whereas the individual stocks, people are not going out and liquidating individual stocks in a panic, because it's too much work for one thing. And so I like the individual stocks because they stand up. I can pick them. I have some different things I use to pick stocks. I have a couple of services I subscribe to, and I kind of take a mix of the 3 different services and look at what the stocks are. So I try to, a big chunk of my portfolios for retirees is actually generating around 5% a year to 6% a year from dividends. And then I don't really care what the market's doing. So as long as they're not cutting their dividend or going out of business, I've got, let's say, 70% of the income that's core income already there. So I don't have to think about it. And then it's a little more work. Clients are like, oh my gosh, I got this brokerage statement with all these things on it. And I know Neil says, oh, 10 or 12 is enough. That may be fine, but I really feel uncomfortable with having more than $20,000 or $25,000 in a given stock. That's just me. So
Sure.
Everybody has their own approach, but I want to make sure that my allocations are small enough that company goes out of business, that doesn't affect their retirement stuff.
Right.
That's my main thing there. And then, and we can talk about charts, but like the index and sector ETFs, I use those as well. Like for instance, earlier this year, technology, Magnificent Seven was the darling of the market, right?
Yeah.
And we saw that in the last chart sharing session we had, that just kind of has gone down since most of the rest of the year. So I moved more into utilities type stuff. I've been using the RSP instead of the S&P 500 because those high flyers are bringing down the market right now. So I'm trying to stay out of the most volatile stuff. And then my volatility products, and all disclosure, I do use SPXY and SVIX. So if we get a big crash in the market, I might go and pick up some of that. And I use that for myself and my clients as well. And my system tells me when I want to be in and out of that. So that's something I can do. And I laugh at my clients because in most of the cases, just doing that part pays all my fees for the year. So they're like, oh, you're almost working for free because your volatility product is paying your annual maintenance fee. I'm like, yeah. They're like, oh, that's nice. So that doesn't mean it always will, but
Yeah.
And then options, I use it a couple different ways. One is because I used to work in Disney. I've had several clients, big clients that are executives. So they had a lot of compensation in Disney stock. And, when you want to go sell $500,000 of Disney stock, you don't really want to pay the tax bill and do it all in 1 year. At the same time, you want to hedge it. So I would be buying puts to basically hedge the stock and then sell some calls against it to help pay for the protection and generate extra income, especially since like Disney only paid, well, they weren't even paying a dividend for a while. So there was no income from it. So that was one of the reasons I used options to generate income. And then also I will use options to hedge the stocks. And then also I will even do sometimes like Warren Buffett sell puts or sell a put credit spread as a way to buy the stock.
Yep.
So we just keep selling like Verizon or something. I'll just keep selling a put credit spread against Verizon. And eventually we make it put and we buy the stock, but we got a decent price and we've been collecting income against it for, let's say, 6 or 7 months until the options got put. So
no, I love that. And I think a lot of people don't realize that's more of how Warren Buffett buys stocks than just buying them. He's usually, the amount of puts that he sells is ridiculous. The premium he gets on those statements is amazing. He probably gets more than that from what he does in appreciation at this point. But
well, and ever since the crash in 87, puts tend to be overpriced. And so there's that money to be made.
Oh yeah.
And once again, I'm usually picking individual stocks to do that because that's a stock I want to buy anyway.
Right.
And
if it comes down to that price, you're happy to own it at that price.
Sure. So let's say you say I want to buy it at $30, and then if you can sell a put credit spread for $1.50, well, even if you get put, you're buying it for $28.50, so you've already bought it for $1.50 cheaper than you originally planned, right? So I think that I don't know how we're doing on time here, so
we're good. We're good. I'll let you know.
Okay. And then the volatility trading, I'm not going to a whole lot of detail, but a couple of things I look at. So what I love about volatility trading is, and this is an old chart, but let's say, the S&P drops, volatility spikes. Okay, great. Then this is where I want to be selling volatility. And the reality is what's great about volatility is if you look at the top chart, you got the market going up and down all along the way, right? Bottom chart, that volatility at some point in time is going to disappear, no matter where the market's sitting. So what I love about it is I don't have to say, well, are we going to go up from here or down from here? I know that eventually the volatility is going to go down, right? It may take a while. I've had some trades that were in 6 months to a year to finally get the money, but it's okay. I know eventually it will happen. So that's great. And so, I mean, if you look at the VIX, this is fairly recent. We had this huge spike on August 5th of 65, right?
Mm-hmm.
So I'm like typing as fast as I can to get trades in to try to sell that volatility and then take it back again. And we got a little kick up again today. So to me, it just adds some, diversification because I don't really care where the market's going. And it's an easy way to, especially with options, there's lots of ways to play that.
Now that recent move happened largely overnight, if I recall. That was on that Sunday night before the Monday opened.
That was the yen carry trade that had to get unrolled, right?
Right.
Yeah. I mean,
so were you just like first thing in the morning doing the sells?
Yeah, for that one, I did a bunch of put spreads. So VXX, because it's a little easier to trade that than the VIX directly, actually, because VIX you can only do options anyway. Yeah. But on the VXX, yeah, so I just basically went short and said VXX is going to drop, and it did. And, I try not to be too much of a pig. I get 70% of the max profit. I take my money and run because it came back down again. And then once it comes down, take your money because you'll get another opportunity.
Right.
No doubt down the road, right? The other thing I do look at, and we talked about a little bit in our chart group, is the VIX term structure, which you can get at VIX Central for free. Right now we're in contango. When things are looking dicey, this front month will kick up higher than the second month, and then things look a little dicey, and that's not the time you want to be shorting volatility. So this is one of the things that you can just look at that chart and at least give you a feel for whether you want to be long or short volatility at that point in time. So
yeah, and imagine that it corresponds right with election time.
Yeah, imagine that. Maybe we'll have another candidate before the next 2 months.
Maybe.
Things change, right?
They can.
Maybe we'll have JD Vance versus Harris. Anything's possible, right? The heck, I gotta have that political humor. Sorry, I can't.
No, I love it. I love it. Cool. Well, yeah. Now we are getting up at the time. I think your last slide has your quote on it.
Look at that.
Yeah. There it is.
Yeah. So this was kind of fun. So I used to belong in an options mentoring group, and we got to visit the SIBO, which is a blast to kind of see the floor. So I said I had to get my picture of the bell in the background there for the SIBO.
Love it.
Yeah, and so anyway, contact me any of these ways. I'm on LinkedIn. And then as far as quotes, I know they like to have a quote. So don't let short-term fluctuations, market psychology, false hope, fear and greed get in the way of good investment judgment. So my attitude on that is, now you may say that means just buy and hold. I don't think you have to look at it that way. I look at it like most of us have a system that we use, right? And so this whole thing, even with options trading, is like, well, today might be a little different because they're bringing out the unemployment numbers tomorrow. So should I put on my trade that I normally put on or not? And like, you kind of got to filter out a lot of the noise because I think most of us back test our systems, ignoring that stuff. So should we really take into that account of that stuff when we actually use the system that we, because then you're using the system differently than you developed it. So when I see these spikes, I say yes. The fear is there, so then I get greedy, right? Just like oil.
Love it.
So yeah.
Well, perfect. Thanks for the quote. Thanks for being here. Last question. Our NAAIM Outlook conference is coming up October 28th and 29th in Dallas, Texas. Are you going to be there?
I will be there. I've got everything booked except the plane fare. I was looking at planes yesterday, so
nice.
I will be there to see you and your wonderful wife and everybody else. And then I've been practicing cornhole, by the way, with the scouts.
Oh, I love it. Love it.
Are we doing a cornhole tournament again or not?
I think not until the spring conference in Los Angeles.
Well, then I got a year then.
Yeah. But no, the conference is a great place to get to know people like Brad, and that's how I've gotten to know you over the years. So it's really great, a great community of people. So thanks for being a part of it.
No problem. I love it because and everybody loves to share their stuff. I mean, it's one of the few things I go to where people really don't hold back. Say, oh, that's my secret sauce. People just discuss what they do. Everybody has a different approach. We're not out to most of us aren't going to change what we do anyway, but it's always fun to hear other ideas and try to incorporate them to what we do in our system anyway. So
absolutely. Well, Brad, thanks for being here. And everybody, thanks again for being on NAAIM Confidential. We'll see everybody next week. Thanks, Brad.
Thanks.